What we're going to do today is to apply those to a series of examples and see how they work in practice. Very important to understand how to do these. This is the single most important skill that you will hopefully acquire in the course. There'll be one question for sure on the midterm, one on the final, where you need to know how to do this. We're going to start by looking at a very typical kind of problem, which is one faced by the Madison Company. They're thinking about replacing one of their machines, and the question is that going to create value for the shareholders? Is it positive NPV or not? Now, they have a projected income statement for the next 5 years, which the management has come up with. And that's our starting point for our analysis. We're going to keep the figures the same for each of the 5 years, just to keep things simple. We're going to have revenues of 100,000. We're going to have operating expenses of 50,000. So the net operating income is the difference between them, which is 50,000. The firm uses straight line depreciation, and the total for the company is expected to be 30,000. So their taxable income is going to be 50 minus 30, which is 20,000. The taxes that the company is expected to pay on that are 8,000, and that leaves us with a net income of 12,000. Now there's a machine that they could replace. We're going to call that the old machine. And they purchased that 3 years ago. And they paid, at that time, $42,000 for it. It was expected to have an 8-year economic life when they purchased it. And now they could sell it, if they wanted to, on the second-hand market for $25,000. The depreciation on this machine is 1/6 of the firm's total. So that's the old machine. Now they can buy a new machine which does the same job, so they both produce exactly the same level of output and so forth. The new machine costs 30,000 today. It has a 5-year economic life. It has 0 salvage value. And the whole point of buying it is that it's actually lower cost machine. It's a newer technology, and so it reduces the operating expenses by 10%. The question is, if we have a 16% discount rate, is this a project which creates value for shareholders? Are they better off if the firm does this project? Now, there are a number of ways that we can approach this. We're going to try and do it in the most efficient way. Here, what that means is we're going to ask the question, suppose that we sell the old machine and buy the new machine. What are the marginal cash flows for the firm? And is the net present value of those positive or negative? Okay, so we're going to sell the old and buy the new, figure out the marginal cash flows. Any questions on the setup? Yes, Pedro.
We sell the machine for 25 and we still have, do we have any on the remote?
So we're going to talk about that as we go through, but that's clearly going to be an important point, how we deal with that money that comes in from selling the old machine. The first thing we're going to do with these problems is to have a table of cash flows. The idea there is to make sure that you understand what changes are going to occur and when they occur, so that you get them at the right date. What's our time horizon for this problem? How many years? 5. We're going to write it as 0, 1, 2, 3, 4, and 5. And it's important to realize that we make the usual assumption that date 0 is December 31st of the current year. Date 1 is a year later. Now, the reason we do that is that it has nice property in terms of taxes. So anything that we have like a loss or a gain, we can do the taxes today, and then the subsequent effects that are in the first year occur at date 1, and so on. So this is December 31st. Now, this is a year from now, and so on. We're going to group the cash flows according to whether they're associated with the old machine or the new one. And the first thing that we have is the sale. What date do we get the money? Now, so it's at date 0 we get 25,000. Now, if we sell the machine today, what do we lose that we would have got if we'd kept it? What could have we done at the end of each year? Tax shield from depreciation. We're going to lose that. We've got a loss of depreciation tax shield. When is the first date that we lose it? 0 or 1? 1. We've already owned it for the whole of this year, so we're going to get to depreciate it, but we won't do at date 1 if we sell it now. How do we calculate the tax shield from depreciation? Yeah, so this is an accounting charge, so we multiply TC by the depreciation. How much is the depreciation on the old machine? Well, we're told what in the question? Depreciation is 1/6 of the firm's total. Yeah. So the firm's total is 30,000. So the depreciation on the old is is going to be 30,000 divided by 6, which is 5,000. And then TC is going to be what? Are we giving it directly? We're not giving it directly, so what do we have to do? We have to figure out from the data we've got what it must be. What is it here? It's 40% because you've got a taxable income of 20,000 and taxes of 8,000, so it's 8,000 divided by 20,000, which is 40%. So what we're going to get for our loss of the depreciation tax shield is minus, because we no longer get it, and then we've got 0.4 for the tax rate times 5,000 for the depreciation. It's minus because we no longer get it, so it's minus 2,000, and we get it from years 1 through 5. Any questions on that? Yes. Sorry. Yes, sorry.
Sorry. So the machine had a useful life of 8 years, and it cost $42,000. And it says you use straight line depreciation. So why does that conflict with the 1/6, and how do you know which one to pick?
So it doesn't conflict. It's because when we calculate the depreciation, what do we do if it's straight line? We take purchase,
Right.
then what do we do?
Divided by the economic life.
No, we have to do one other step before we divide it by the number of years. We have to subtract out salvage value. And that's where we're at next, because if you sell the machine, you're not going to get what?
Okay. So then wouldn't the prior year's straight line depreciation have been...
So we'll get to that one we'll be in that one in third. Let's deal with this salvage value. So if we sell this machine now, we're not going to get the salvage value. So let's figure out what that is. So we're going to have the loss of the salvage value. That's going to be in date 5. And the question is, how much is that salvage value? Well, we're not given it, so we have to figure it out. We know that straight line depreciation is the amount that you pay minus the salvage value divided by the number of years. So we can figure out that the salvage value must be equal to the purchase price minus what? Minus the 8 times the 5,000 per year depreciation, so it's 2,000. So that's how we get that in this particular example. So we've got minus 2,000 because we no longer get it. Do I multiply that by TC, 1 minus TC, or what? If you sell an asset, what are you taxed on? The gain or the loss? So we're going to make the usual assumption that the company declares to the tax authorities what it really believes the salvage value is going to be. So this is what they stated at the start. That's still the best estimate. So if you sell it for book value, what's the taxes? 0. So we don't have any tax effect here. Does everybody understand that? Sell an asset for its book value, there's no gain or loss, and therefore no taxes.